and welcome. Today we are joined by Chirag Dagli. He's fund manager at DSP Mutual Fund. He manages the healthcare and multicap funds at the AMC. In this conversation, we'll get his take on everything from market volatility to performance of the pharma sector. Chirag, thanks so much for being here.
Pleasure is all mine. Thank you so much for having me.
Now, let's dive right in. So, what sparked your interest in equity investing?
So I'm a chartered accountant by qualification, and my elder brother was already in markets. Very early on during college, I was very, fascinated by the stock market. This was, back in the uh, uh, during the Harshad Mehta days, and a lot of money was made, etc. And obviously, like a natural middle class guy, I was attracted to the money that a lot of people were making. So I've always been interested in the markets. Fortunately, I became a chartered accountant early on, and I was fortunate enough to start working in the stock market, and and then since there on, it has there has been no looking back.
Okay. So it's been a long journey, Chirag. Could you help us understand your investment strategy, investment style? How do you select the stocks in the portfolio? It would be great if you can elaborate on these things.
Sure. So I think at heart of the stock selection process is to, the underlying principle is that you want to buy stocks which are trading at lower than their intrinsic value. And there are many ways you can slice and dice and look at intrinsic value, depending on current earnings, depending on replacement cost, and so on and so on. There are multiple ways of slicing and dicing this, but the core principle is that you want to buy stocks which are lower than their intrinsic value. Um, Once you've done this analysis, that let's say you look at a particular sector and identify a stock within that sector that, look, this is the best company within this sector to kind of own based on valuation, management quality, potential opportunity to grow, execution, all of those things in forensics, all of those things in. Once you compare all of this and you conclude that this is the stock to own, there's a next layer of analysis that you do, which is basically on the portfolio construction side. So the first layer is research, right? Equity research in its purest sense. The second layer is portfolio construction. And in that portfolio construction, you essentially put stocks into four buckets, right? Growth stocks, value stocks, compounders, and turnaround sectors. So essentially, once you put a stock in a specific bucket, then you compare that stock with various other stocks in that bucket, but across multiple industries, right? So that allows you to do it allows you to do two things. One is that not have a very big style skew. So I'm not a value investor or a growth investor. I think these are all labels that we call ourselves. And at heart, like I said, everybody wants to kind of buy stocks which are pricing, which are mispriced in some sense. So, for example, if a stock is pricing in a growth potential of 20%, and if I view that that growth potential is not 20, but let's say 25, then I'd buy that stock, and so on and so forth. So the idea is to not have any specific style skew across, and to put stocks in these four buckets and have a good optimal mix of each of these four buckets. Now, if you look at these four buckets, and let you spend a minute here, is that growth stocks are essentially, like the name suggests, high growth stocks, good quality managements, ticking all the boxes on the forensic side, all of those things, all of those things are a given, right? Those happen at the first layer. These are only stocks that you're comparing from the potential opportunity standpoint, right? So you compare two growth stocks, look at the potential opportunity to grow, how fast they can grow, and what is the price indicating in terms of the growth potential. So that's on the growth bucket. Similarly, on the value side, these are companies that are not growing as fast as the GDP, lower than the GDP, likely very soft multiples as well. Again, here as well, you try and look at where is the market narrative wrong. How is the market thinking about these stocks differently? If there's a stock which is a 5p, 6p, 10p, what is the market telling you in terms of the long-term terminal value of these businesses, and is the market wrong or right around that? That's the second bucket, which is the value bucket. The third bucket is the compounders, which are essentially companies that are growing in line with India's GDP. These are well-run, large companies. The usual big names come to your mind. So that's the third bucket. These are stable companies. Their stories essentially are the India story, that if India does well over the next 10 years, we'll also do equally well, if not better. So that's the third bucket. And then there's a fourth bucket, which is essentially a turnaround kind of a bucket. Now, the last point I want to make is that we don't want to have a very big style skew across these four buckets, and have a very reasonable optimal mix around this. But that does not mean the portfolio will be 25-25 in each of these, 25% in each of the buckets, right? Depending on market conditions, it is intuitively it is intuitively right to assume that compounders will have a much larger weight, turnarounds will have a much smaller weight, and growth and value will probably be by and large equalish kind of weight, is how a portfolio construction will likely happen, because turnarounds are also high risk, and that risk needs to be kind of adequately priced as far as the stock price is concerned. So that's the thing. One thing which in my mind I'm very clear is that a reasonable capital efficiency is a must across the entire portfolio. The only bucket where a lower than mid-teens kind of return on capital is tolerated is the turnaround bucket. These are because these are companies that are going through a unique situation. They're going through a down cycle. They're going through a big phase of investment, and hence their reported capital efficiency is poor. So that's the only bucket where a poor capital efficiency is tolerated. In all the other three buckets, a reasonable capital efficiency, like I said, mid-teens is something that we kind of look for. Mid to slightly higher teens is the capital efficiency, which is it is non-negotiable. If you look at traditional theories of finance, if your cost of capital is 8-9%, add a little bit of risk, you to have lower than 12% kind of capital efficiency, just each day that you do business, you're probably destroying value and not creating value. So generally speaking, these are the guardrails or thought process that we have. Now, I'm not looking for very high capital efficiency companies as well, right? There's no thought process that we look at it only 25+% kind of ROIC kind of companies. That's not the thought process. The thought process is reasonable capital efficiency with reasonable valuations and growth potential.
So, Chirag, at heart of your strategy is buying the stocks which are trading below their intrinsic value and which are available at the reasonable valuations, kind of thing.
Yes, yes. But our traditional thought process of a 50p stock is expensive, that is not the lens. A 50p stock is actually the markets are telling you a specific implied growth potential of that stock. The idea is, if the market is wrong in that assessment, or if we view that growth potential to be very different than the market, then we'll likely participate.
So everything depends on the growth of that particular stock, particular company.
Correct. Valuations and growth. Yeah. Implied growth expectations, which stem from the valuations.
Right now, Chirag, with the recent pullback in Indian equities, do you think the worst is already behind us, or are we in for more volatility?
No, so I think generally, difficult to make very forward-looking comments. But one thing in my mind is very clear: volatility is bound to rise. It will increase. We are in an uncertain world. A lot of traditional, political, what was a given, are being now questioned, and we're in for volatility. Volatility is here to stay for sure, and a lot of this is stemming from global volatility, not as much India. in that sense, we are in a sweet spot, but naturally we are, today world is far more globalized, and in that sense, we don't operate out of an island, right? So global uncertainty and hence volatility in the markets are here to stay. And I don't think that it can be said that volatility is behind. The form and shape, the contours will change. But things remain very, very dynamic and take one day at a time is how I would say.
So when do you expect this volatility to subsidize, or growth to come back in the markets, bull market kind of thing to come back in the markets?
I think volatility subsiding not anytime soon, because the traditional, dollar being store of value, uh, you know, traditionally what used to happen, we always used to bake in a dollar appreciation, right? Some of those things are being questioned, right? And we know all that data is there. It has been around for 3, 4, 5 years, maybe a decade as well. And people have been highlighting that this is unsustainable, that US debt is unsustainable. All of those things are known, and they've been around. And you can always say that they were there 5 years back, 3 years back, 2 years back, and so on and so forth. But there always comes a point when some of these things unwind. We don't know what shape or form this unwind will take. And in that context, I think this volatility is here to stay, to be honest. Can't say for sure when it will, end. I would also say that for the broader retail investors, this volatility, um, there is no point in actually trying to guess this volatility, right? And this is something we've written in our letter to investors, that let's say in December 2019, if you would have met an oracle or a seer or whatever, a guru, and you would have made 4 or 5 big predictions. You would have said in the next 3 months the world will shut down, there'll be a global pandemic. Thereafter, 6, 12 months thereafter, there'll be a war in Europe. And 6, 12 months thereafter, there'll be a war in Middle East. What would your natural instinct have been? Your instinct would have been, oh, India is going to go to hell. War in Middle East, crude will go up. India is a net importer of crude. World is hell. Oh, Europe may war. Europe is a big market for India. We export to Europe. There's going to be a problem. Global pandemic, world will shut down. Tough. Your instinct would have been to not or pull back money out of the market. 5 years fast forward, your equity wealth has probably doubled. So I would say that trying to forecast these things just tough. Easier thing is to look at your equity, at your asset allocation. That I think is in your hands, and that I think is what ought to be the focus, irrespective of all these things. These things will come and go, right? So there'll be times where equity will look very attractive. There'll be times when equity will not look as attractive, etc. For a retail investor, I would say by and large, sticking to asset allocation, I think, is the key. There's nothing else that matters really to the retail investor.
But Chirag, then how difficult is it for a fund manager like you to manage the fund when the visibility of the volatility is not clear? It might continue for 3 months, 6 months, a year. So how difficult or easy is to manage the money and pick up the stocks in such scenario?
So I think we focus a lot on bottom up really, and like I said, for me, if the market's going to be extremely volatile, right, or uncertain, but if valuations kind of bake that in for a specific stock, right, then I'm okay, honestly. Then I will take those bets that, okay, look, this is today in down cycle. And honestly, if you look at my portfolio, we have some loss-making companies as well, with a very clear understanding that these companies are today in down cycle, right? So we're buying those companies, right? And why are we buying loss-making companies, right? Not that we have some great insight that this will turn around 1 quarter, 2 quarters down the line. There is some view around that, but it is at best a view, right? So, but you do know that valuation comfort, you are seeking much higher valuation comfort. If that valuation comfort comes through, then you kind of try and manage the other things. So that's how we think about it. Beyond a point, um, to build a portfolio with a view that this will happen, especially on the macro side, it's, I think, tough. So which is why the framework as well, that don't have a style skew, have a very well spread, diversified kind of exposure. Um, and if you look at healthcare as well, the healthcare also I run in a very similar fashion, to not have a big style skew, whether value or growth or so on and so forth. And which is why the focus is a lot more on bottom up and a lot less on macro. Of course, there is a view on the macro, but not a very large weightage as far as the portfolio build is concerned around the macro.
Chirag, now, since the DSP Multicap Fund is a really new fund in the category, can you share its strategy and how it aligns with our broader investment principle? We all know that you have to invest 20 to 25% in the large cap, mid cap, small cap. But are you doing anything differently in this scheme?
So two or three things that are a little different. One is where by its very definition, multi-cap has higher as a category versus flexi-cap has a much higher weight towards the small and mid-cap. Something which is unique with DSP's multi-cap fund is that we have a lot of stocks which are below the Nifty 500. So the country has 500 big, largest names which trade in the market. We have about 13 to 14% of the portfolio, which is even below that, right? That's one thing which is, a little unique with DSP multi-cap fund. And the other thing that we are trying to do, I think we'll always be a lot more focused on the small and mid-cap categories within multi-cap. And that's just because, we think that is where the opportunity really lies in the small and mid-cap, space. India is growing very well. And really, India is changing from the bottom up, right? So I think that is where we see a lot of opportunity really. And that I think is something which is unique to DSP, our higher weight towards the small cap as a category, stocks even below the top 500 names in the country. The other unique thing about DSP is our ability to invest in international names, essentially US listed names. Today, we don't have any in the multi-cap, but we are unable to do it. At some point where we don't find opportunities in India, we can buy international names. We do this in the healthcare fund. About 14% of the DSP healthcare fund is invested in US listed names. So we think something similar we can achieve in multi-cap as well, but at an opportune time, depending on stocks and depending on whether there are opportunities that are not present in India and they are present in the US.
Right. Now, if I look at the portfolio of DSP Multicap Fund, you did mention that, you'll always be more focused on small and mid caps, but 47% of it is in mid cap stocks, around 47% of it. So what gives you the confidence in mid caps despite the elevated valuations?
So small and mid put together will be a little more than about 65 odd percent, small and mid put together, right? And the reason I'm clubbing the two is that these categories classification changes every 6 months, right? Something which is small cap becomes mid and vice versa, etc. Generally, the churn you don't see too much on the large cap side, but especially in this category, you see. So I think given the size of the fund and the depth of coverage that we have, DSP has we have a history of running the micro cap fund. We have a large small cap fund as well. Given that vintage, given that legacy, we think some of these businesses we understand very well, and we can benefit out of the insights in some of these businesses. By and large, if you look at, one of the things we've always said is that better part of the last 2 years, we've been saying small and mid caps are expensive, right, on an absolute basis. But that's when you look at the index. That's when you look at it versus the large caps. I think small and mid cap investing is a lot about bottom up, right? It is a lot about stock selection. I don't need to own 500 names, right? I just need to own 30, 40 good quality names in the small and mid cap space. And where I see enough opportunity, enough stocks, enough opportunity, which presents, especially at the size of the AUM that we have in the multi-cap. Like Chirag mentioned earlier, we are relatively, we did the NFO last year. So we're about 12 odd months, shade more than that so we're a small fund. I still see opportunities that we can, buy in the small and mid cap space, despite the fact that the overall index may seem expensive versus the large cap and so on and so forth.
Now, Chirag, coming to some of the specific things on the healthcare sector, the hot topic right now is the US tariffs. To what extent it can have an impact on the Indian healthcare companies? Do you think it continued? Can this can have a long-term growth effects on the industry?
So look, first the numbers, right? US is a large $900 billion medicines market, right? At patient prices or at whatever, consumer prices. $100 billion out of that is essentially the generics, right? So we are 10% of the overall medicine bill, right? In terms of value. In terms of volume, it's exactly the reverse. So out of 10 pills that a consumer consumes, 9 are the generic medicines. And one of them is probably the innovator's medicine. So we are small in the context of the medicine prices is the point that I want to make. We're large in context of the volume, but substantially small in context of the value. When Mr. Trump wants to cut prices on medicines, do you think he wants to attack the 10% bowl in terms of value, or do you think he wants to attack the 90% bowl in terms of value? So that's point number one. Point number two is that when you look at the $100 billion, give or take, worth of price at which the consumer is paying for the generic medicines, the manufacturer is actually making only 40 out of that, right? So 40% is what the manufacturer is making, right? There's a large part of value for the generic drugs which is sitting in the US. That value addition is actually sitting in the US. These are pharmacy benefit managers, wholesalers, retailers, which are making that that part of profits. So having talked about these basics, now when you think about tariffs, right? Let's take the example. Let's say if there is a 10% tariff, just give or take, right? Because today India does charge. We import from the US about $400 million worth of medicines at a 10% import duty, and that is what Mr. Trump has said, like for like, and so on and so forth. So let's go by the 10% number. If there is a 10% tariff, it is going to be at manufacturer prices, right? That's going to be on 40. That's actually 4 on at the consumer prices. And that's actually substantially lower for the entire medicine bill for the consumer, right? So it's 10% on 40 in a market which is 900, correct? So it is not very high to pass on, is the first point. Second point is that a large part of the value actually sits in the US, so they make a lot of money. Manufacturer on the other side does all the work. We have all the factories here, the R&D is here, the product development is all here. So we're spending all the capital, we're taking all the expenditures, and not as much money is being made as those guys. So I think with these two things in mind, in my mind, I think we are very clear that tariffs will be passed on. Two, the impact may not be very high. And tariffs are very easy problem to solve. For example, India can actually just say that we will import drugs from the US duty free, right, at zero tax, because we are today earning only $40 million on a $400 million medicine import that we are doing. We export $9 billion worth of medicines to the US. So it's a very, very easy problem to fix as far as just the pharma tariffs are concerned. What happens, we don't know, of course. What eventually happens also is something that we don't know, because there may be some announcement today, then there'll be retracing back and so on and so forth. But how I'm thinking about this structurally is exactly the numbers that I just told you.
Right now, in the current derating phase, which pharma subsegments do you think are offering a margin of safety, and where do you still see frothy multiples?
So look, I think from a segment standpoint, CDMO is a space that we are excited about. China plus one is a very, very important trend that we are seeing. It started post-COVID. It has picked up steam recently, and I think that's a very that's a segment where I think there's a lot of visibility of you know China is very large. China is more than 80% of the CDMO industry globally, and we want to take market share there, and we have the capability. So I think that trend is very, very important. Uh, Valuations are a little high in the entire space, but I think the growth is also there. The momentum is very, very strong. Not yet saying that uncomfortable with valuations on CDMO, but it's clearly a space that we like a lot, and we think that there is structural growth over there. The other piece that we think we like is the challengers in the US, which is companies that are today small in the US generic market, and are now trying to build up presence in the US. So in the US, if you look at the market, or there are these large companies, all the large big names, they have large businesses in India and as well as in the US. But there are also the smaller companies which are now trying to build presence in the US. There, I think we are seeing opportunity. Because US as a market is becoming increasingly more and more unattractive for newer players to come. And pricing, we are hearing for a lot of commodity generic products, etc., is now flatlined, stabilized, and so on. So the environment in the US will at the margin keep getting better. The only caveat here is that the US is a market where a few companies are making a lot of money in a couple of products. So product concentration along with very high valuation multiples is a no-no for us, and we are avoiding some of those names. But otherwise, as a structural 2-3 year view, small companies that are trying to build a presence in the US is something that we are excited about. The third space where we think that business is good, valuations again a little punchy, is the hospital space, where say post-COVID, a lot of valuation re-rating has happened, and rightly so, because capital efficiency of the business has improved, maturity has improved, and we're seeing also a big trend of smaller hospitals actually trying to corporatize and selling themselves to these corporate chains, etc. 5 years back, there was only maybe 2 or 3 hospitals to invest in. Today, we have a choice of between 12 and 14 hospitals to kind of invest in. So the breadth of the sector, as far as the public markets is concerned, is actually going up. It's a sector we really like. Hospitals is a very stable, nice business. Regulatory action is the only thing that we worry about in this one. But that said, I think the sector, the business is doing fine. So yeah, these were the broad, and the India business continues to chug along to grow in that 7, 8, 9% kind of zone. Growth is a lot lesser than it has been in the past. A little bit of this is structure, and a little bit of this is actually just loss of exclusivities, etc., which were there in the base. That is now kind of normalizing. So. But I think the market continues to grow in line with GDP is how we're thinking about the Indian market per se. Indian branded market per se. So that business continues to chug along. And the last bit is on the diagnostics bit, where I think growth uh, post pre-COVID, there was double-digit growth. All of these companies were growing in the 16% zone. COVID came, then normalized. Growth came down after COVID. We are now seeing growth come back, nowhere near the 15 that they used to earlier, but broadly in the 10-11% zone. So, and valuation multiples have also corrected from the good old COVID days. So, I think today valuations a lot more okay versus what we've seen in the past.
Chirag, before I come to the next question, just wanted to understand. You spoke about that you invest in the US stocks also, some bit of portion. So how is it? Because because right now the limits are off. So how do you go about it?
Sure. So we have some limits. That's one. So we have some limits. See, what are we trying to solve for is the larger point to address here. We are trying to solve for something which is an opportunity and is adding to GDP, right? But I'm not able to participate in the market capitalization creation in these things. So things like genomic research, things like medical equipment, are things where there is no Indian company which is present. But these are services that Indians use. And as a consumer, you and I, when we get admitted in a hospital, we go through a robotic surgery, we put implants, we do genomic testing is also going up and so on and so forth. So as consumers, as Indians, we're using these, but there are no opportunities to participate. That is how we want to go out and participate in market capitalization or whatever, value creation in these segments, in these markets. That's what we are trying to kind of address. And we are seeing opportunity today in these two segments, essentially medical equipment and genomic research.
Now, Chirag, you spoke about it, but with the China plus one trend gaining significant traction in the recent years, and the API segment has become a crowded space given the opportunity size. Do you think could result in an intense competition and thus contraction in returns, or is there enough room for growth of all players?
So look, when we talk about CDMO, we talk about CDMO for innovators, right? And CDMO for innovators, um, I mean, our largest company will probably have a 2% market share, maybe actually even less than that, 1% market share, right? That's the potential that we have, right? And uh, we are not competing amongst each other. We are actually competing with the Chinese because they are very large, right? So yes, it is becoming at the margin, getting a little more competitive. But am I worried that it hurts pricing? I'm not so sure that is today at least more relevant. Today it is more relevant to actually up the game for Indian companies to improve their capabilities, to improve their chemistry capabilities, and deliver products on complex chemistries and so on and so forth, rather than to really worry about pricing. This is on the innovator side. On the generic side, on the generic API side, market has always been very, very competitive, and it continues to remain so. And that I don't think is changing anytime soon. This market will remain competitive. Remember, Indians are competitive with the Chinese at a fraction of the Chinese scale. That I think is the most important piece that I want to highlight. Chinese maybe multiple times in terms of India's scale for a specific product. And still Indians are competitive. And that I think is the real opportunity. It comes gradually. The whole that market remains competitive. But the China plus one element of customers trying to shift away from China, that's equally prevalent in generic API as well, albeit at a very cost sensitive environment versus innovators, which is not as cost sensitive.
You mentioned you're excited about the CDMO space. Can you share your thoughts on the sharp inflow of CDMO opportunities for Indian pharma players? And do you think the space can get saturated quickly, or is there room for more players?
No, there is room for more players. Like I said, the largest company in India is $500 million. Innovators say, supplies to innovators, maybe 600 in a more than 30 plus $1 billion market. So, I mean, we are very, very small. There is a lot of opportunity really. And see, we think about it as one sector, but these are multiple chemistries. Each of the companies are good at some chemistry, not so good at the others. A pharma company needs multiple chemistries to go to get into a product and so on and so forth. So I don't think I'm worried about mm, crowding out, at least on the innovator CDMO side here.
Chirag, from the retail investor point of view, what is an emerging segment in the pharma industry they should pay the attention to? And are there any areas that one should stay away from in this sector?
So look, I think from a sector standpoint, pharma generally, healthcare as a whole is generally a very stable sector. If you look at the BSE healthcare index, its earnings have the index earnings have compounded at a 12% kind of ballpark over the last decade or so. And this is the index as a whole, right? And with all these multiple segments, etc. Something goes down, something else comes up, and so on and so forth. So generally, I think by and large, if you look at the index, about 80% of the index is a very simple, real linear growth kind of a thing. The US generic is the only cyclical bit in the entire sector, right? And there we are, I think, like I said, we are going through a good phase today. So we are not worried, honestly, about anything excessive happening for the sector as a whole. For retail investors, I would strongly recommend that they should not do direct investing in pharma, in healthcare, uh, more specifically in pharma. Because when you buy a healthcare fund, and it can be an index fund as well, active or otherwise, that is the investor's choice. But if you think about wanting to have an exposure to healthcare, having that through a direct stock is far more risky. Ask yourself this question, that all the big great companies in India have gone through a bad FDA inspection cycle. The question to ask yourself is that, let's say, if I buy a stock that goes up, if I buy a stock which is 2% of my portfolio, the stock does well, it goes to 4% of my portfolio. What happens when it goes through a bad FDA inspection and on that day, the stock goes down 10-20%? How will you react, right? That's the question. So in my mind, I think I'm very, very clear. Retail investors have to avoid direct investing, especially in pharma. Other sectors are, hospitals, etc., are a little more linear. They're also, you can go wrong on valuation, froth, etc. That's a different point. But in pharma, this is extremely prevalent because FDA inspection is a big risk. And what will you do on that day when a large portfolio stock goes down 10-20%? Because on that day, everything you read in the media is going to be negative on the stock, right? And we've seen companies go through those cycles, come out a winner. Some companies never come out a winner, and so on and so forth. So it's just easier, I think, for a retail investor to buy or to participate in the healthcare sector as a mutual fund or an index fund.
Okay, now about the diagnostic space, you mentioned that we're now seeing growth come back and valuations have also corrected. Also, there's intense competition and aggressive consolidation that are the new trends in this space. So, how has it changed the dynamics of the industry, and what do you think is the end game for this trend?
So look, I think at the margin, competition is actually coming off a little bit. See, diagnostic business has no entry barriers, right? It's very easy to enter. There is no entry barrier. The barrier is the scale, right? It's easy to build a 50, 100 crore business in diagnostics. It doesn't take much. The equipment comes on financing. The big equipment suppliers give that equipment to you, and you can just consolidate volumes and then start doing business. Question is to make money. Question is to scale the business, right? If you look at the listed space, right, the 5-6 names, all of those are companies which have actually scaled up, right? And hence they are successful. And hence they're making the kind of margins that they're making. At a lower scale, that margin is not available, right? And which is why, and everybody's tried. A lot of people have tried, really. A lot of people have tried to see this business is very difficult to scale simply because I can do something at a small scale. Imagine I'm a radiologist and I start a business. I can do it for 1 center, 2 center, maybe 10 centers. The moment I move out of my city into another city, into another place, it's a very, very logistic intensive, operations intensive business, and hence not very easy to kind of scale up. So uh, people are now realizing this the hard way. A lot of private equity money was sloshing around 5 years back. A lot of those companies tried to scale, were not able to. One thing which is very, very evident now after 5, 6 years of history that we have is that just by discounting, you can't scale this business beyond a point. You will get initial success because you're cutting prices. Some B2B business will move to you and so on. But to sustain that business level and to grow thereafter, just very, very difficult. So I think that I think is very, very clear. So at the margin, competition is actually coming off a little bit. On the M&A side, I think what has happened is that initially there were a lot of deals, and now you see deals are not come as easy to come by. Simply because we now have 6 listed companies in the diagnostic space. So why will any seller want to sell cheap? Right? Because he's able to see the multiples of listed companies, right? Very easily. So earlier deals used to happen at, you know, 6, 7, 10 times EBITDA. Today, those deals are not available because these companies are trading at much larger valuations on the public side. And those valuations are evident. You can see them. Just very difficult. So I think the M&A opportunity certainly overstated. And that trend will actually slow down a little bit. But organic competition will also come off a little bit. A little bit of mixed, I think. I mean, I would say not very easy to just say that, these are very positive or very negative trends.
Chirag, now coming to the hospitals, which are typically capital intensive businesses, how do you evaluate whether a company is deploying capital prudently, especially when expanding the bed capacity or entering the new geographics?
See, I think the business has always remained very good, hospitals. When you look at reported capital efficiency, right, reported return on capital, pre-COVID, uh, these companies used to suffer very low capital efficiency. Now, that does not mean that the business inherently was inefficient, capital inefficient, right? Uh, so if I'm adding 4,000 beds on a base of 4,000 beds, then I will suffer a lot because it takes typically 2 to 3 years for a hospital to come up, right? All my capital is in. When that hospital comes up, it takes another 2 to 3 years for me to actually start running the hospital and then start making money on that. So there's a 5, 6 year period, right? It's a long gestation and capital intensive business. So when you're adding on 4,000 operating beds, when you're adding another 4,000, it hurts your P&L for a while to come. This is what these companies actually went through. Fast forward today, what is happening is that companies that are size of, they are now adding 10%, 20%, 25% capacity to their existing beds. So the burn of new beds on the older ones is much lower. And hence you are seeing improved capital efficiency. Inherently, the business was always capital efficient, right? But it was this cost of growth which was actually hurting overall capital intensity. So I think the business remains capital efficient, very, very attractive businesses. And I don't think that view is changing. But what is changing is really this trend of more standalone hospitals actually trying to corporatize or attach themselves to a larger corporate hospital. And that is actually helping the overall growth potential for some of our listed hospital names.
Now, finally, the last question. So, what do you think will be the key growth factors for Indian healthcare companies in the next decade?
I think healthcare is one space which is not one segment, right? There are 6 or 7 sub-segments. We talked about each of these. Very, very different drivers for each of these. Indian formulation market continues to grow, and that in line with GDP, maybe slightly lower. And the drivers are, very simple, really. India is 29 median age today. We will age. As we age, we consume more medicines, better medicines, higher quality medicines, and so on and so forth. We seek better healthcare services. The kind of healthcare service that my father seeked and I am seeking, and my son will seek, very, very different. And you can see a scale difference in the expectations of the younger consumers, in terms of the quality that they're seeking, in terms of the price that they're willing to pay for the services that they're seeking, because a lot of it is paid by insurance and so on and so forth. So these are increasing medical insurance is again a structural driver for the Indian healthcare market, and it actually layers around multiple of these subsegments. It helps higher diagnostics, it helps higher hospital revenue, it helps higher medicines, and so on, so on and so forth. So that is, I think, a younger India aging over time, and higher increasing insurance, medical insurance, helping seek better, higher quality services. Again, is something a very big driver, and that layers across most of these subsegments. On the export side, I think the drivers that we've seen in the last decade, I think equally are important for the next decade as well. India is the pharmacy bowl for the world. We will remain the pharmacy bowl for the world, much more so, because for the most part of the developed world has actually moved away, right, to biologics, complex medicines, to autoimmune disease, to oncology, and so on and so forth. So they are not focused on these large mass market medicines, cheaper drugs, and so on and so forth. They don't bother, really. So that is the sweet spot where India actually comes in. We can export to the whole world, US also, and non-US as well. Non-US is also equally large as an opportunity. It's a very fragmented, diverse opportunity. Europe, Russia, multiple markets, but it is an equally important, good opportunity. And there again, these countries don't have too many options outside of India to procure medicines from. So that's another big driver for the exports business. And finally, I think some of these new frontiers of innovation in medicines. So, for example, if you look at the next 12 months, the weight loss drugs will be generic next year, and they will be widely available in India next year onwards. We'll see how that evolves, but it's surely going to change the healthcare dynamics. It's certainly going to challenge the status quo that we have today. And we'll see how some of these new innovations in medicines is actually changing. But a lot of innovations happening, and that certainly is a big driver for healthcare as a sector as well. A simple example is cataract surgeries, right? 10 years back, cataract surgeries would take a day and you'd spend 5 days in recovery, right, with those blindfolds on your eyes, etc. Today, cataract you get done in 20 minutes, maybe an hour, and in a couple of hours of recovery, and and you're back on the second day, you're back in office, etc. So on and so forth. Not wearing those black glares, but just something to protect so that dust doesn't come. That's innovation, right? And that innovation comes to at a price, right? And it helps the whole ecosystem in healthcare. So this innovation constantly is happening in the industry. That is in itself a big growth driver for the industry.
Well, with that, it's time for us to wrap up this chat. Chirag, thank you for sharing your thoughts with us today.
Thank you so much for your time.
Thanks.
Thank you, Chirag.
And thank you to our viewers for watching. Stay tuned for more expert insights and don't forget to like, share, and subscribe for more videos like this.